Gold has been on an absolute roller coaster lately, right? Hitting these crazy record highs only to come tumbling back down. And it's left a lot of us asking the same question. Is this recent dip a golden opportunity to get in, or is it actually a gilded trap? Well, let's break it all down and see what the experts are really thinking. I mean, just look at the first few months of 2026 to see what I'm talking about. In January, gold just skyrocketed to this mind-blowing all-time high of almost $5,600 an ounce. But then, bam, March hit, and it was a serious reality check. A sell-off that wiped out about 13% of its value. Now it's kind of hovering around 4,700. Seriously, what a ride. So what on earth is causing these massive swings? It really is a classic tug of war. On one side, you've got all this rising geopolitical tension, which, usually sends investors running for the safety of gold. But pulling in the complete opposite direction are these fears that the Fed is going to keep interest rates high, and that makes holding an asset like gold, which doesn't pay you anything, a lot less attractive. Okay, so despite all that recent chaos, a lot of the big players on Wall Street are, believe it or not, still pretty optimistic. So let's dive into the bull case and see why so many of them think this rally is actually far from over. A recent gold market report really hits the nail on the head here. It says the consensus is that the underlying trends supporting gold's rally are not exhausted. So what does that really mean? Basically, they're saying that the fundamental reasons gold was climbing in the first place, we're talking central bank buying, geopolitical risk, those things are still very much in play. And when I say optimistic, I mean really optimistic. Take JP Morgan, for instance. They're talking about a potential long-term price of $6,000 an ounce. Now, that is a huge leap from where we are today, and it suggests they're banking on this global uncertainty sticking around for a while. And they're not alone. Goldman Sachs is right there with them, targeting $5,400. And get this, that's not some far-off dream. They see that happening by the end of this year. That tells you they think the current momentum has some serious legs. And then you've got UBS, who is even more bullish. Their forecast goes as high as $6,200 an ounce by the end of 2026. Let's be clear, these aren't just small predictions. They represent some really significant upside from where we're sitting right now.
So, why all the confidence? Well, it pretty much boils down to these four key things. First, central banks all over the world are just snapping up gold to move their reserves away from the dollar. Second, regular investor demand is growing. Third, in a world that feels pretty chaotic, gold is still seen as the ultimate safe place for your money. And finally, it's a fantastic stabilizer for your portfolio. Think about it this way. When your stocks are zigging down, gold has this great history of zagging up, which helps smooth out the overall ride for your investments.
Okay, that all sounds pretty great, right? But it's only half the story. To make a smart call, you absolutely have to understand the risks. So let's flip the coin and look at the bear case. What could send gold prices tumbling down? Probably the biggest argument against gold right now is something called opportunity cost. Owning a non-yielding asset like gold, it's kind of like owning a beautiful classic car. Sure, it might go up in value, but it's not paying you rent every month. In a world where you can get a pretty solid return from a simple savings account or a government bond, it becomes a much tougher decision to lock up your cash in something that generates zero income. And if you think gold only goes up, well, history has a pretty painful lesson for us. You can't forget that gold is capable of some really severe corrections. Between its peak in 2011 and its low in 2015, the price of gold actually collapsed by 45%. That just goes to show you, what goes up can definitely come back down, and sometimes it comes down hard. On top of that, there are some other major headwinds. A strong US dollar, for example, makes gold more expensive for anyone trying to buy it with other currencies, and that can really put a damper on demand. The recent volatility is also a huge concern. I mean, it's jumped 46% this year. That is a wild ride that not every investor has the stomach for. And of course, if you're buying physical gold, you've got to factor in things like storage costs and even potentially higher taxes. So what's the potential floor here? Well, remember that super bullish target from Goldman Sachs of 5,400? They also ran the numbers for a worst-case scenario. If things get worse and market stress really picks up, they see gold potentially falling all the way back down to $3,800. That is a serious, serious risk to keep in mind.
All right, so we have this powerful bull case with some analysts seeing prices over $6,000, and then this really sobering bear case with a potential drop to $3,800. So let's put it all together and get to the expert verdict. Is now really the time to buy?
When you lay it all out side by side like this, the conflict becomes crystal clear. On one side, you've got these massive price targets, strong demand, and gold's proven role as a safe haven. But on the other, you've got that high opportunity cost, a history of painful drops, and a strong dollar creating some serious headwinds. So ultimately, there is just no simple yes or no here. The consensus from the experts seems to be that it all comes down to your personal investment timeline. If you're a long-term investor and you really believe in gold's role as that portfolio hedge, then yeah, this dip could be the very entry point you've been waiting for. But if you've not a shorter time horizon, that extreme volatility we're seeing right now is a major, major risk. And that brings us right to our final question, the one you have to answer for yourself. With all the facts laid out, is gold's recent pullback a rare chance to buy before the next big leg up? Or is it a flashing warning sign of the significant risks that lie ahead?